Hi everybody, Brian here from quantlabs.net. Today is September 25th. I haven't done a video in a while. Lots of changes I made to the strategy in terms of controlling the scheduling of it being on or off, blah blah blah. I did an event on this last night and now part of my Python course. So just wanted to give you the latest updates of where things are at. Currently I'm testing the strategy, as I've mentioned in one of my videos about over trading, having your system run basically 24/7. I've stated that maybe it might be wise to put a trading target every day on your portfolio, what your goal is. Mine for now is at 1% up, and if the strategy is trading in a losing day of a situation of down day of protect the account, do not trade beyond negative 0.5% or 0.5% for the day. So what have we got going on? So let's check out the latest stuff on CoinMarketCap. I'm starting to rely on this less and less because of the strategy or the script that I've written that's very precise. I will tell you from the patterns I've seen over the last 2 weeks, regardless of where the crypto asset class is at, it does move up and down. I'll talk about it in a bit on the, let me just get rid of these distractions here. What I can have is that, you know, the cryptocurrency space oscillates from, on average, around 1% up on the move. If you look at all the major crypto pairs, versus on the downside it can be down 0.5%, 1%. So I'm kind of in line where you need to understand the nuances of how the overall cryptocurrency space works and flows, and figuring out your thresholds on what you want to do to maximize your trading opportunity on top of your downside on to protect your trading account and trading performance overall. I will say it is very, very volatile. Cryptocurrency is not only volatile, but you can see here on the 24-hour space here that it's pretty extreme. 10%, 3%, 13%, 8%, so on. So those are very extreme moves. They're fast moving. If you get the right side, you can do very well. But then on the other side, expect it to get hammered, as let's say XRP here, Ripple, was up 40% last week, and just in 24 hours is down 13%. This could go down 20%, 30%, and come back at 13%. It's so volatile. So there are ways to smooth out that volatility by having very conservative, very and going after consistent profit, but only being able to really have tight controls and thresholds on your trading account and performance. So in here, I just want to show you, let's say with a database. I've shown this before. Here it is. I have a way to turn off the strategy, set that to true. Everything gets turned off. Here's the latest risk. You can see here the crypto. I'll show you this in more detail in a minute. Is everything's negative, just completely negative. I will show that to you right now. I have two versions of this script here that I'm about to show you, and as I said, I've been relying on it very carefully. I have this risk on 3, which I just developed, and risk on 2. Difference between the risk on 3, it's a lot more detailed. It generates a Word document report. On top of it, it'll email out and automatically post onto my analytics backend for all my analytic members. So we have that. Question is, how frequently do we run these? The detail of this will really change your trading profile immensely by what I'm about to show you. So here you can clearly see just in the last few hours, I'll even run this now. This was run about maybe an hour ago. This was run 3-4 hours ago, and I'll show you what else is on there. So what we can clearly see here, we measure the big coins, Bitcoin US dollar, Bitcoin Cash US dollar, Litecoin US dollar, the Ethereum Classic US dollar, and Ethereum or Ether against the US dollar. So you can see the big swings here, down 2.04%, Bitcoin down 0.67%, not big. That's the big boy, as we all know. The granddaddy is Bitcoin. So when you see these kind of heavy losses at 2%, 1%, those are pretty big. But what I will say, they do move together. The question is how much, like in terms of the change of the or the speed of the change is something that you need to understand. Here, right here, if we had the shorting opportunity, we obviously want to be shorting Ethereum USD because it's down 2% versus others that are at 1% or down even 0.67%. Again, we're trading in Binance, so we can only long only. But imagine if you had the this positive. Obviously, you'd want to be putting more money into Ethereum US dollar versus Bitcoin because it's up, 2%. If that we were to reverse, as I said. So as time progresses, you can clearly see that this pace of loss now is down 2.75% versus 2.04%. That's important to note. Again, you can see here it's down 1.4% versus 1.16%. Those are big things you need to note at the pace of the losses, and not just the pace of the loss, but if you have what I call a risk-on day, obviously you'd be making more money faster if this was 2.75% in the positive versus 1.42 in the positive. So here we've just ran this. We can see here Ethereum is now even losing faster than before, 2.75%. So these are really important factors that we need to understand. And I need to also note, these are measurements of the last closes over the last 3 hours. So those are measured for 3 hours and 6 hours. So this is why on CoinMarketCap, this kind of becomes useless because, unless you're trading all day and only using end-of-day data and only using end-of-day data, trading on that, you will you don't care about the intraday. But I will say your potential for profit is not going to be as good as if you trade on the intraday, because if you watch a lot of my videos on investing.com, you will know that all the real profit can be made in a matter of hours, and the opportunity is gone. And I can also tell you that the opportunity can come and go within 5 minutes. So you want to be able to find ways to capture those profit opportunities. So we come back to here. The change of rate of change is a very important measure. That's what I use. And not only that, but I also use the percentage of it as well. So let's check out some of the reports here. So this is the Quant Analytics backend. These are new tests that I've been running. So here what we have is we are able to have a trading report. That's the reports that I've shown before. Let me just show you this. So here's a report, what's inside this zip file. These are, we can get signals based upon volume. We can also get trading signals, again, long only, based upon trend. These are two different things. And then we can also get just a standard everything, crypto long, and that will track everything. But I'll show that. That's part of my analytics. It's pretty detailed. So then we come into the crypto risk on or off assessment. This is now noting the time at 12:53. Yeah, so let's check out this one. So we have here two of them. Actually, it's just a name change of the title. Or actually, let me just show you this one here. So this is really important to understand. This is the difference now between these two scripts I was mentioning, risk on 2, risk on 3. So this is now the results of risk on 3. So when I download this file, it's a document, a Word document. So let me just pull it up. this one right here, and yeah, so this is what we want. So here we are in the risk assessment. I've shown this before, all of this stuff. This is important though. The timestamp is pretty critical. As I said, the market, we call this a market regime. We're in the negative for sure. But this is the important stuff now. Because I have the ability now to measure not only are we just up or down, I can get very specific. For my testing, you do not want to be trading when everything's negative. So we have 5 cryptocurrency pairs. Everything's down. I'm starting to lead into the point. It's like this. If you were in 2008 and everything around you is falling, and you got a falling knife situation, why would you trade that? That is now risk off, which means you don't trade it, hold on to your cash, maybe even trade something else because there's always trading opportunities. But this is trading outside of the cryptocurrency asset class space. But we'll deal with that in the next couple of months as we move into Forex, CFDs, blah, blah, blah. So here is how aggressive if everything is up. So for instance, if all of these 5 are over 1%, then we are in aggressive mode. We can switch up the trading strategy or the algo and change all the thresholds to be in what I call aggressive mode. Maybe 2%, 1% moves, and focus on those. And then we move into a medium mode, meaning everything's moving up between 0.5 and 1%. So depending upon the threshold here that I set, if we have, let's say, 2 of these cryptocurrencies are moving over 1%, but the rest 3 are moving in between 0.5 and 1%, then we just go into a medium mode, and then we set everything, all our tolerances, maybe to 1%. Then we have something what I call anemic, and this is critical right here. When you look at these numbers, you're going to go, okay, I don't want to trade it. It's a falling knife situation. There's probably, if I was to trade something, or even let's say put on a position, there's a very, very high probability I will lose money on that trade. So therefore, maybe I shouldn't trade it. That's what the pros do. Okay. So if we're in this mode, we need to understand 1 of 2 scenarios will take place. We have a situation where it's been negative, which in this case, currently it is. But eventually, over time, over a few hours, there will be some of these cryptocurrency pairs will start to move out of being negative and be 0 and move into where some, or a good chunk of them, will be in between the range of 0 and 0.5% or 0.5%. So it's anemic, and if there's enough momentum, and there usually is from what I've been testing, and the testing and the momentum, it starts to pick up as what they call escape velocity, meaning that if the momentum of the overall asset class is starting to move up, then overall there's a factor of overall the asset class is starting to move up, momentum's building, and that momentum is being driven by algos or human traders or whatever in the network of Binance, noticing that now they come back to the market and they start to put on a moderate, medium risk on profile. So that means if the momentum starts to come in, there'll be more traders come in, be it algorithmic, systematic, or human. They'll build up that momentum. And over time, within a few hours, maybe 1 or 2, maybe 3 hours, that mode goes from medium to aggressive. So they start to move in and go into really aggressive mode and try to profit off of that opportunity. Now that can last for a couple hours, and then over time, the momentum starts to come off, and then it starts to go back to medium and anemic. And I wanted to highlight this. This is very important to understand. If you're in an anemic mode, coming out of negative, you're probably starting to build profit potential. Momentum's starting to build, but it's not quite where you want to be. But then there's the opposite end. If you're coming out of aggressive mode, it falls back to a medium mode with a risk on, call it. Then it goes into anemic, and then eventually hits negative, and that's where we're at. And I've seen this pretty well every day over a 24-hour cycle. It can be from 1 to 2 periods where it will switch that market regime from negative to aggressive over a 24-hour period, and it usually takes anywhere from 6 to 9 hours for that period to move from negative to positive. Sometimes it might not be fully aggressive where everything's above 1%, meaning all of these, but usually it will at least go into a medium mode, and then it may or may not, depending upon the momentum, it will go into the aggressive mode. So knowing that, obviously you got to make sure that if you're coming off in an aggressive mode, that you become more conservative on your trading targets and your thresholds to ensure that you understand that overall the asset class is coming off of an aggressive mode, that you may start to take more losses on those trades, and you have to be very careful. So you need to understand, are you coming off of an aggressive mode wave? And if you are, then you may want to still want to trade but not be as aggressive. So that's why I have these different modes. Again, we don't trade in negative mode. We do not trade in anemic at all, I don't think, but still watch it. And then you start to pick up a little bit of trading on the medium, and you definitely start to go into what they call a day trading mode and just trade as much as you can and take full advantage of that opportunity. So if I was to run this again, let me just see where we're at, compare our situation. So you can clearly see something. Okay, so this has not changed at all. So again, what I just ran here is, you know that the markets, the asset class is heavily in a down mode, and I don't think I want to trade it. It's the risk off. That's what we describe it as. So I want to quantify this a little better, and now that I have this report and have the ability to run it once an hour, twice every 2 hours, 3 hours, 4 hours to get that measurement, this alone is worth signing up for because of this little ability to figure out where everything's at in terms of the crypto currency asset class space. And then again, we have the other report, which combines a variety of things for buying signals and buying potential. So this becomes kind of useless now unless you're a human trader, but if you're an automated trader or systematic trader, this will become much more useful because it switches and gives you the notice and the assessment every few hours or whatever I set it at. If it's once an hour, twice an hour, three, whatever I set, how frequently it will wake up and run. So just want to show you that, and let me know what you think. Talk to you later.